Good morning. In the interest of time, we'll go ahead and get started as you make your way to your seats. I'm Chip Skinner. I'm chair of Christ Church's Arbor Society, and I'm thrilled to be leading a panel discussion this morning entitled Will Writing and Estate Planning 101, Pitfalls and Possibilities. That's a mouthful. We will be exploring several timely topics, including what comprises a good plan, why everyone should have one, and what we need to know ahead of the potential upcoming major tax law changes. Before I introduce our expert panelists, I'd like to set the table. There are many reasons to have an updated will and estate plan, and many reasons why we keep putting it off. We fear death. We don't want to discuss financial matters with family members. We don't want to give up control, and we don't want to take on a big project that we can push off into the future. As Bill Zabel, one of the godfathers of estate planning, has said in his book called The Rich Die Richer, the will-making experience can and should be a healthy and open confrontation of our true feelings about ourselves, our death, our property, and the people and causes we love. It represents a life well lived and an estate well planned, and a final expression of our philosophy of life. Plus, it can be a huge feeling of relief and a weight lifted. With that, I'm delighted to introduce our star-studded panel of estate planning experts. We have first off, we have our very own Andy Fraley, Christ Church member and practicing estate attorney here in Greenwich. She's with Ivy, Barnum, and O'Meara. We have Joanne Butler on the end, state attorney and principal at Cummings and Lockwood, one of the largest, I didn't realize this, one of the largest trust and estate practices in the U.S. with offices in Stamford. She's also helped my family with our plan and did a great job. And last but not least, we have Craig Standish, partner with Brown Advisory, the firm that manages the church's endowment. A former private practice estate attorney himself, Craig heads up Brown's Boston office and co-heads its strategic advisory group. I might also note that Mike Gaughan is here with Brown Advisory somewhere. Mike, raise your hand. There he is. He actually manages our endowment for us, and he's here also. So let's get right to it. I have a list of questions, but I want to save some time for Q&A. So maybe starting off, Craig, what are the 4 or 5 basic building blocks to a good estate plan, and why are they important?
Good. Well, thank you, Chip. I know we're all happy to be here today, and thank you for coming. And we know that this can be a heavy topic. Maybe I would start off by echoing what you said. Sometimes people in this field can talk mechanically about estate planning a lot, but I think we also acknowledge that these are sensitive conversations for people, and that's okay to have feelings around this. So I'm happy to kick off with what I would say, I think probably all of us would say are what are the core elements to having an estate plan. I'd say there's a few documents that apply really during lifetime, and then there's a few that really kick in more so at death. The few that apply during lifetime, I would say start with a financial power of attorney, right? Imagine the circumstance that you're incapacitated for some reason and you're not able to make your financial decisions, right? This is a document, 5 or 10 page document that appoints an agent who's able to step in and make your financial decisions in the event you cannot. Think decisions like access to your checking account, managing your investments, signing your tax return, those types of things. I would say someone in this role should have some sort of organizational ability, some wherewithal that can work with other advisors, and sort of calmness under pressure. The other lifetime document that's just as valuable is a power of attorney for healthcare, called different things in different states. But same notion, right? You're incapacitated and unable to make your medical decisions. You designate an agent who can step in and make those decisions for you. Again, it sort of varies by state, but you can sort of enumerate the powers that you want them to have. You can say what sort of end-of-life care treatment you want. You can make decisions around end-of-life treatment and other options. I would say, again, who's the best person to fill this role? Someone who's really calm under pressure, right? Think like you're in a bad state, your family's worried, and you need someone who can interact with doctors and make decisions that are in your best interest. This role, critically, is meant to sort of carry out what your wishes are, and to the extent your wishes aren't known, this person is meant to carry out what they think your wishes would be around treatment and end-of-life care. The other two documents that more so apply at death are your last will and a revocable trust. These tend to work sort of interchangeably, but they're the documents that deal with disposition of your assets when you pass away, whether they're outright or whether they're in further trust to your descendants. They often include bequests, like charitable bequests or familial bequests. And importantly, again, in those documents you name an executor as to the will and a trustee of your trust who have ongoing decision-making authority around distributions to your heirs and family and administration of the trust over time. Maybe I'll stop there and see what I'm missing.
I hope this works. The healthcare proxy, just keep in mind, when your kids turn 18, you can't talk to their doctors. So before you send your kids off to college, you might want to get them to sign a designation of healthcare representative, because things do unfortunately go wrong on campus sometimes. And I've gotten the call, there's been an accident, I need to talk to my kid's doctor, they won't talk to me. And if they don't have that document signed, you might be involved in a court proceeding that you want to avoid. It's a very easy document, so before you send them off, maybe get them to sign that.
That's a great point. Thank you for that, Craig. Related question, and maybe for Andy, what is wrong with the belief or the premise that estate planning is just for us older people and not me, but wealthy people?
No, really, it's definitely for everyone. I sometimes say, if you think you don't have an estate plan, you have an estate plan, because the laws of intestacy of the state of Connecticut will give you an estate plan, and it may not be the one you want. If you don't have a document signed, the assets will go, if you're married with kids, sort of $100,000 plus half the balance to the surviving spouse, and the rest to the kids. If your kids are minors, you've got restricted accounts at the court. So you have an estate plan whether you know it or not. Also, you're going to have a lot of assets that don't pass under your documents, okay? You're going to have life insurance with beneficiary designations. For a lot of people, their retirement plans are a big part of their estates. You got to make sure those beneficiary designations are coordinated with the rest of your estate plan. You may have interests in trusts that your parents set up for you. You may have transfer on death accounts that maybe shouldn't be transfer on death accounts. Maybe you want them to pass under your plan and into a trust. So everyone needs an estate plan. I think, even if you're younger, particularly if you have young kids. I have a little list of people who really need an estate plan. If you have a prenuptial agreement, you need an estate plan, because you probably have commitments in there, what we call, estate provisions, that you have to do something for your wife when you die, and it better be in your estate plan. If you're recently separated or divorced, you should look at your estate plan. You may have to do something for the ex under the estate plan. You don't want to be that guy who keeps the ex as the beneficiary of the 401k, just by accident. If you or your spouse are not U.S. citizens, you need an estate plan. Different estate tax laws apply to non-citizens. And finally, if you have children with disabilities, a child with a disability, you definitely need an estate plan to plan for that child.
Thank you. Craig touched on two of the 4 or 5 fiduciaries that are involved in an estate plan. Joanne, maybe you could touch on the role of the executor and the role of a trustee.
Okay, as Andy said, hello everyone. So first, hello, I'm Joanne Butler. As Andy mentioned, your executor is the person who acts under your will. This is the person that will sign your estate tax returns. This is also the person that you trust the most with, basically it's marshaling and valuing your assets, which is a very big deal. A lot of people name their surviving spouse and then their children as their executors, and one of the pitfalls is by naming too many people in this position. I've had some estate plans where they have 3 or 4 people named as executor, which is not what you want to do. So typically for a married couple, you would name your spouse, and then perhaps if you have adult children, they would be the second. So they are, like I said, they are charged with marshaling and valuing your assets, and they will ultimately be signing your estate tax return. That's an executor. The trustee, and in our case, we're going to talk about a trustee of a revocable trust, and I'm going to talk a little bit about the difference between a revocable and an irrevocable trust. The revocable trust works with your will. The revocable trust is just you in trust form. It's another way of administering your estate without court supervision, not because we're doing anything nefarious, just because it's administrative ease to have a will which pours into your revocable trust, and then your assets are managed there. A trustee of your revocable trust, again, would be typically you are the person who creates the revocable trust is the trustee, and then you would typically name your surviving spouse as your successor trustee in the case of incapacity or if you didn't want to serve. And again, probably children after that. I'm talking about children like they're adults, but if you have minor children, then you would name a trusted advisor. And think about the trustee of your revocable trust being kind of like the person you would name as your agent under your financial power of attorney. Again, the same thing. They're going to be doing the same things for you while you're alive and maybe incapacitated. So that person would be someone who is organized, understands your assets and knows where they're held and how. So those two roles, executor and trustee, are somewhat the same but different. The executor role only is about 3 years. That's how long it would take to administer an estate, whereas the trustee role is ongoing. I don't know how you want to get into the trust. Your revocable trust becomes irrevocable at death. That's why that trustee role continues. And maybe we should talk about the differences between
Sure.
revocable.
In a simple word or two, what is a trust?
A trust is, there's no
This is the
simple
question
route
I
for
asked
that.
you when you were helping us.
Angie, do you want to take that one?
A trust is a division of ownership where the trustee has legal title to an asset, but there are the beneficial owners who have sort of the economic interest in the asset are the beneficiaries. And the trustee's job is typically to keep trust records, manage the trust investments, make sure the tax returns get filed, and importantly, exercise discretion in making distributions to the beneficiaries. We can say in some states you could bifurcate these roles
Yes.
now. That's a little bit in the weeds. You could do a directed trust with someone appointed to manage the assets and someone else appointed to make distribution decisions. But that's the general notion of a trust. The trustee has legal title holding assets for the benefit of someone else.
That's why you sometimes hear about people creating Delaware trusts, because they have that bifurcated role. There's other roles: trust protector, trust advisor. You could probably talk a little bit about this.
I would just add, the role of trustee is really important, right? Because if you imagine you and your spouse have passed away and you have ongoing trust for the benefit of your children and grandchildren, et cetera, the trustee often is the person who has control or decision-making authority about making distributions to those beneficiaries. So it's a very important role. I would say there's what I see is a spectrum of kind of who's the right person or entity to play that role. On the one end, you have family members, and I think you would argue correctly that family members know the family the best. So in some sense, there's logic to having a family member play the role of trustee. On the other end of the spectrum, you have professional trustees, right? Lawyers often play that role, investment firms, banks play that role. Often the professional trustees, they may not know the family quite as well as the family members, but they know the rules incumbent upon trustee. They know what's required, they know what tax returns are due, accountings that need to be made, et cetera. So I think what I've seen in my career over the past 20 years is these two things coming together, right? I feel like it's much more common nowadays that you might have a family member and a professional serving as co-trustee, because you get the best of both worlds. And as long as someone in the family has the ability to make changes there, remove someone, remove a trustee and replace them, it can be a really great working arrangement.
And so a professional trustee is considered an independent trustee, and sometimes you need that for tax purposes to have an independent trustee make certain decisions that the beneficiary trustee cannot.
Yeah, I was also going to say, some of these trusts go for a long time. If you're putting assets in trust for your kids for their lifetime, you need to be thoughtful about the trustee, the successor trustee, and then making sure there's a mechanism for replacing. And by the way, you may want to put assets in trust for your kids' lifetimes. There's different reasons you might want to do that. But overall, the point, yeah, you have to be thoughtful about the selection of your fiduciaries, especially the trustee.
No question?
I was just going to mention, when we talk about trust, there's two kinds. There's inter vivos trust, a trust you create today, which is a revocable trust, or you can create an irrevocable trust during life. When you're giving away assets irrevocably, they're no longer yours, and people do that for tax purposes. And then there's trusts that arise under a will, which we wouldn't recommend, because we would say it should be a will which pours over into a trust. So there are two different kinds of trusts, and just for practical purposes, if you have a trust that's created under a will in Connecticut, you are always subject to the supervision of the probate court, and we try to avoid that through the will to revocable trust plan.
Also, Connecticut will tax the trust, even if your beneficiaries live out of state. So we are unanimously in agreement. Try not to set up your trust under a will. Get a revocable trust agreement.
Also, a revocable trust is good if you have out-of-state real property. A lot of people own properties in Florida or Tahoe. You would want to title your real property in the name of your revocable trust to avoid probating in those two other states.
Great, thank you. So just got a phone-in question. Are there any ways to make family members or estate beneficiaries happy, or at least happier during the estate planning process?
No.
Can an estate attorney help guide or mediate this part of the process?
I hear that and I say, you don't have to make your family members happy necessarily in your estate plan. I mean, if we've been practicing a long time and we see a lot of stuff, like if you have a child who's in a shaky marriage, that child could probably benefit from a lifetime trust. You may have a child with gambling issues, addiction issues, spending issues, and you've got to do what you think is in the best interest of your family members. They may not always agree with you, but sometimes that's just going to be appropriate. I think if you have, the elusive, harmonious family with grown kids who are all doing well, you can have a discussion. There's something called the generation skipping trust that you could leave assets in a lifetime trust for your kids so they do not become part of your children's gross estates. You're helping your kids manage their own potential estate tax liability for the sake of your grandchildren. So it's fair to say, grown, successful child, would you benefit from a generation skipping trust? Do you think, I'm meeting with my estate planning attorney, this is something they've suggested, why don't we talk about that to see if you might benefit from that? And with the understanding that that trust is supposed to help your family work for the family, not to frustrate your children.
So all of a sudden I'm talking a lot, but one of the things is sometimes hard to get your adult children to sign prenups if you are concerned about your own assets flowing through to your child that child will get married one day, and if there's a divorce, you can lose some of your assets through that divorce. Having a trust for your child it's easier than asking your child for a prenup when they're in love and they don't want to think about that. You can protect your assets from going to that future divorcing spouse. I know that's depressing to think about, but that's one of the benefits of having a trust for a child.
Let me just add two tidbits to extend it's helpful. One is, most families that I've worked with, if the kids are treated differently vis-a-vis each other, they think that you didn't love them the same. So I would say if you're treating kids differently, think carefully about, I'm not saying there aren't reasons to treat kids differently, but if you are, think carefully about how and if and when to communicate that. Because I've seen it not very often, but I've seen it occur where the parents are gone, kids are treated differently, and now there's conflict created that maybe could have been avoided. The second is, as we've been talking about, trustees for ongoing trusts have a lot of authority generally to make distributions. Oftentimes you see trusts that have very broad language that distributions can be made to beneficiaries for really any reason. Sometimes that puts a burden on the trustee, right? Because a kid comes and says, I need a distribution because I'm buying a house or I'm starting a business or I want to give all my money to charity. What's okay? And oftentimes, I've worked with families who have written these sort of non-binding side letters to the family and maybe to the trustee and said, I know I'm giving you all this broad authority, and there's reasons that I'm doing that, but I really want you to know what's important to me. Education is important to me. Home ownership is important to me. Like, write some of that stuff down. It gives the trustee guidance on what type of distributions you would want, and it lets your family members know as well what's important to you. So it puts some looser guardrails on distribution making authority that I think can be helpful for families.
You can also put that in the trust document too. You can have like a guidance to trustees section, and you can also do it as a side letter, as you mentioned, called a letter of wishes or a letter of guidance. So you can do it either way.
Thank you. Switching gears here a little bit, let's talk about tax change. I guess minimization or deferral of state and federal estate taxes is a big reason to have a will, perhaps a trust. In the U.S., the government allows a certain dollar amount to be removed or exempt from the estate tax calculation. Could someone give us a brief history of the current tax legislation and maybe just tell us how that is possibly going to change in the next 12 months or so?
Okay, help me out, but I'm going to give my best shot. We had estate tax exemptions after 2012, about 5 million with an inflation index. In 2017, we got a doubled exemption with the Republican tax cuts. To get that higher exemption passed, by the way, it's currently $13.61 million federal and state. Per person, so over 27 million for a married couple. To get that legislation passed, they had to pass it with a built-in sunset. In the higher exemption sunset at the end of 2025 next year, okay? So we have a lot of clients who are like, oh, well, right now I could give away, by the way, it's a combined sort of estate and gift tax exemption. You could give away 27 million when you're dead, no estate tax, or gift it now. So we have clients contemplating making gifts because they're like, we could give 27 million now, but if we wait till we die, it may be, we don't know what it'll be 13. So if we get no legislation, and I think it's fair to say this country's not very good at passing legislation, but if we get
agreeing on
anything, yeah. If we get no legislation, we kind of go back to 2017, which is 5 with an inflation index. Goldman Sachs has that at about 7.2 million per person. I also think if the Democrats got their wish list, which is sort of a sweep, they'd want 3.5. I mean, well, not at least a few of them.
One in particular.
One in particular, Senator Elizabeth Warren. I love her. She's my law school professor. She does like taxes, though. So, we'd be back at 3.5 million per person, which is a big change from 13.6. And there's other things that would come along, basis adjustment issues, but just sticking with the exemption, it may go down a lot. There are certain people who may want to consider gifting, as Joanne said, to an irrevocable trust. That's the kind of trust we use to irrevocably part with our assets before those exemptions lapse.
But there's really, you really have to think about whether you want your life and your assets and your family to be driven by taxes. So I always tell my clients, it's really up to you what you want to do. And let's not panic just because the tax laws are going to change, because if you feel like you can part with that much money now, I don't want you to have remorse, which a lot of our clients had in 2012. They gave, well, some of them gave it away and they kind of regretted it because the exemption went up. So we don't know what's going to happen. We know it's going to sunset absent legislation, but the tax laws can change 4 more times during our lifetime. It could be 0, our exemption, and it could stay going up. So we should think about that and think about how much you feel like you can part with now, just because the law may be changing. So you really should think about, and the way I like to say it is, if you wanted to take advantage of the higher exemptions now, you have to give away more than you think it's going to revert to. So if it's going to revert to 7, and you were thinking about giving away 7, there's really no reason to do it. So you have to give away more than that, and I don't know that a lot of people anywhere, or maybe just in this room, or me, want to give away that much money now because of the tax law change. So that's the way I like to think of it.
Yeah. Most estate planning attorneys aren't worried about dying with more than $27 million. It's not really the problem we have, but some of our clients have that problem. Yeah, and obviously there is an election coming up. And so, certain clients are, I think my client, I've had conversations about dumping a lot of money. By the way, there's a lot of different ways to set up these trusts. They have all these acronyms, SLATs and Dynasty Trusts and SPATs and whatever. But
there's a way to give it away but still have indirect control.
Right. But some of my clients, I think, are kind of in a holding pattern. They're waiting to see how the election comes out. I think the Republican platform is to extend the higher exemptions.
Thank you. Andy, I think your firm has put out a paper sort of addressing the question that we're all getting these emails about a $99.99 will online. Is that a good idea?
No.
Well, I know that sounds self-serving, right? But look, I've had one or two clients like, "Ooh, I printed it offline. Can you edit this for me?" I gotta tell you, it's much easier for me to start with my forms than to edit what the people are getting offline, because they don't get everything right yet. Tax apportionment clauses, we have an estate tax in Connecticut. Does it plan around the Connecticut estate tax, or does it only addressing federal estate taxes? I think maybe if you were a single person with no kids and wanted to leave everything to your brother, with your brother as the executor, that might work for you. But I think the answer for most people is it's not there yet. Plus, remember, you have all these other assets we got to coordinate. You've got life insurance, you've got retirement benefits, you may have TOD accounts, you may be a beneficiary of your grandfather's trust, and it's very hard to get that online. So sometimes the question is, are you worried about AI? Is AI going to take your job? I'm like, I can't be any less worried about AI at this point. We're all so busy, so.
Is Connecticut a good state to die in?
No.
Okay, but it's not as bad as New York.
Right.
Can you expand on that?
For New York, so New York.
Connecticut. Why is Connecticut bad?
Well, Connecticut has a gift tax, so I'm being unfair. So Connecticut is the only state that has a gift tax. The only state out of 50 states that has a gift tax. So think about that.
What is a gift tax?
So when you make a gift during life, you're using some of your exemption, and Connecticut has its own. So in New York, you can make a $13 million gift, well, asterisk. You can make a $13 million gift during life, and I use 13 million because that's the federal exemption, without having to worry about New York tax. In Connecticut, if you make you're using both of your exemptions if you make a $13 million gift. New York, however, has a 3-year look back and a cliff. This is probably beyond the scope of this discussion, but New York is worse than Connecticut.
Yeah.
But Andy may want to expand on Connecticut not being a great state to
look,
die in.
the northeastern states have state estate taxes. A $13.61 million Connecticut exemption. You want to speak about Massachusetts for a minute?
Right.
Make us look good.
Make us look good.
Yeah, so the federal exemption is 13.61. Connecticut is the same for estate tax purposes. Massachusetts voters just voted a change in Massachusetts. We're very excited to announce that we've doubled our estate tax exemption from 1 to 2 million per person. So you could argue that Massachusetts is a worse state to die in because the state estate tax would be more punitive.
Is there a state that's lower? I think
Oregon, last I checked, Oregon was $1 million as well.
What about New Jersey? I think New Jersey is.
I think New Jersey doesn't have one either.
Oh, okay.
Florida has no estate tax.
But lots of hurricanes.
Very good. Well, let's say Christ Church, which is in its 275th year now, is an organization that you would like to see prosper into the future after you're gone. How do we go about leaving a legacy gift to Christ Church or a charity like that?
Well, maybe I'd start by saying you need not wait until you're gone. Maybe that's a plug. Right, so there's lots of reasons to do charitable giving during your lifetime. And there's lots, in addition to the feel-good reasons, there's good tax planning reasons. So there are limitations on what you can deduct from an income tax perspective on lifetime charitable gifts, but it's generally worth it. And a lot of families that we work with are in good dialogue with their accountants toward the end of the year to make sure that they can try to maximize lifetime gifts to public charities like churches or their private foundations. The IRS also now and has for some time, allows you to use part of your required minimum distribution from your IRA to go to charity. So I work with a lot of families who are not reliant on their RMDs to support their living expenses, and so using some, and as you know, when you take a distribution from a traditional IRA, that's taxable income to you. You can allocate up to $105,000 this year directly from your IRA to a charity, and it doesn't come through you and through income tax to you. So lots of good reasons to do lifetime charitable giving. And then at death, same. At death, there's an unlimited charitable deduction for estate tax purposes. So even if you're worth $1 billion and you die and leave it all to charity, that zeroes out your estate tax liability. So there's good tax deductions at death. And the format can take many different approaches. There's outright charitable gifts, there's sort of restricted gifts that we see families doing, there's multiple forms of lifetime trust that you can set up that we call split interest trust that may benefit a charity for a period of time and then benefit your family, or maybe benefit your family for a period of time and then charity at the end. So there's lots of really great and wonderful opportunities to do philanthropic giving, I'd say both during your lifetime and at death.
Do you see a lot of donor advice? Haven't me asking questions. Do you see a lot of donor advised funds? I mean, that's a way to do it. You could set the donor advised fund up during life and put some money in it for income tax purposes, and then that you can also, under your will or trust, put more money into that same donor advised fund. You probably do that a lot.
I work with a lot of really wonderful philanthropic families, and most of them these days are using donor advised funds. I'd seen like a little bit of slippage from private foundations. And for a couple of reasons. Private foundations are wonderful and historically were predominantly used, but there's a lot of administrative expense and work that goes into the upkeep, the ongoing maintenance of private foundations, state filings, federal filings, tax filings, et cetera. And they have the 5% minimum distribution you have to have a trustee or a board of directors. There's a lot of administrative pieces. A donor advised fund is really just like a charitable giving account that you set up at a community foundation or a provider like a Fidelity or Charles Schwab. And it's really quite simple. There's no regulatory work on your part. There's no filing work on your part. You can make contributions to it. You recommend distributions out to qualified charities. And so what I've seen over time is, in many cases, kind of winding down of some private foundations in favor of donor advised funds because of their administrative ease. I would say, I often get the question of, if I'm, at what threshold dollar amount should I use a private foundation instead of a donor advised fund? And my answer to that is, I don't think it's a dollar amount difference. I think if you want to use a charitable vehicle that sort of flow through, you're putting assets into it and cash distributions are coming out of it, irrespective of the dollar amount, I think the donor advised fund is probably the right way to go. If you want to do more active charitable giving, like sponsoring road races and gala dinners and all that sort of activity, you can't do that in a donor advised fund. You have to do that through the format of a private foundation.
I just want to add, I like clients to look at their retirement plans for charity. Remember, when you name your kids as beneficiaries of your IRA or 401k, when distributions come out to them, which for the typical beneficiary, they do all that account has to be emptied by 10 years after your death. That's 100% ordinary income taxable to your kids. So I say give your kids sort of your kind of non-qualified assets. Give the IRA to the charity because they get both the income and the estate tax deduction for the IRA. IRA is like tax bombs in your estate, unfortunately. It's just so if you can, if you have the IRAs or 401ks and you want to give to charity, just keep that in mind.
And the other thing you can do with an IRA is do a Roth, convert it to a Roth. That's which is you paying the income tax up front now, and then the IRA will pass tax-free. So that's the other way to do it. But that's not for everyone, but there is another option.
Terrific. I think at this point we'll open it up to questions. Does anyone have a bunch of questions over there? Pam.
Thank you so much. So in the lens of this conversation, how would an estate planner work with a financial?
The question is, how would an estate planner work with your financial planner?
You're the financial planner.
Yeah. So, well, I can at least speak for my firm. So, my firm, Brown Advisory, is an investment firm. So we have people like Michael who's here who are portfolio managers. And then with the people in my role who are estate planners by background. We tend to, this is not a criticism, we tend to see our clients probably with more frequency than their estate planning lawyers or their accountants do. So oftentimes we can play the role of kind of idea generator or issue spotter, can be a little more proactive because we hear what's going on in our clients' lives, and be kind of good thinking partners. And then when you have some sort of thoughts that you're noodling around, is the right time to bring in the client's estate planning lawyer, perhaps their accountant, depending on what you're thinking about or some analysis that you're doing. I'd say importantly, in my experience, when working with estate planning lawyers, it's very collaborative. Joanne and I actually work on clients together, and so I'm sensitive. I think everyone's sensitive to that. Lawyers are billable hour people, and investment firms or financial advisors are generally not. And so sometimes we can be the, absorb some of the non-billable stuff that occurs to sort of maximize both the time efficiency and the cost.
You don't work for free, though.
No, I'm like a pro bono lawyer.
Right. Asset managers get a fee. I'm in that business, so that's...
Yeah.
And sometimes clients will just refer us to their financial planner for what assets they have and how they're held, and that's very important for us to know that. And they kind of give us a sheet. You give us a sheet of the assets, and then we're able to work together about maybe changing the beneficiary, like we discussed. If you have a TOD account or a beneficiary designation, and you're doing an estate plan, you want to make sure that those things coordinate. And a lot of times, you can help. The financial planner can help with retitling and take that off of your plate. So it is very, very collaborative, and we really couldn't do it all without you guys. So, yeah, not just you.
Another question.
Well, you can name whoever you want as a... The downside of a TOD or a payable on death account, so we're talking about a bank account that has a beneficiary or investment account that has a beneficiary. If you have a will or trust that says that you want your assets to go into trust for your children or to your husband, it's not going to flow through your will. It's going to pass by beneficiary designation. So the only thing that's passed at death to your will and revocable trust are assets that you hold in your name individually. Not things that pass by beneficiary designation, which is an IRA, a payable on death account, or life insurance, or that's held jointly. Typically, you own your home as joint tenants with rights of survivorship if you're married. And if you wanted to, well, there's other reasons to change it to tenants in common for equalization purposes, but if you wanted your house to pass another way, or you wanted your bank account to pass another way in trust for your children or in trust for your spouse, the TOD is not going to help. It's going to go a different way. So you have to think about how you want your assets to pass, the way your estate plan says it's going to pass, or a payable on death account.
The beneficiary designations will trump your estate planning documents. Just think of it that way. So, if I have clients, they have 27 million of generation skipping transfer tax exemption. They want to use all of it to fund lifetime GST trust for their kids. We plan on using their brokerage accounts, and then they die, and it's like, oh, the brokerage accounts pass directly to the kids. How am I going to get those now into the generation skipping trust? So that's why titling and beneficiary designations are really important.
Another question back in the corner.
So,
Question.
yeah. So the question is getting at the income taxation of irrevocable trusts. So your normal estate planning revocable trust is not its own tax-paying entity, right? So if I set up the Craig Standish revocable trust and I fund it with my investment accounts and they generate income and dividends, et cetera, it all just shows up on my individual income tax return. It's not a separate entity. But where we've been talking about these trusts that you can set up during life that are irrevocable, that you make a gift using some of your estate and gift tax exemption to, those trusts can be structured in one of two ways. They can be structured to continue to be taxed to me, even though I've made a gift of the assets, like I can't control them, I can't benefit from them any longer. The income could still be taxed to me. There's some benefits to doing that, allow the assets in the irrevocable trust to sort of grow without the drag of having to pay income taxes. Or they can be structured in a way so that the irrevocable trust pays its own income taxes. And the point that you're getting at is, as everyone knows, for individual income taxation, we have a graduated rate system in this country, and to get to the top 37% tax bracket, a married couple has to have $700,000 of income, something like that. Irrevocable trusts that pay their own taxes are in a much more compressed bracket system, so they hit the top 37% ordinary income at like $13,000 of income. So that is one reason that when we are setting up irrevocable trusts with families, we talk about how they should be taxed. Should they pay their own taxes? Is there benefits to having the grantor, the person who set up the trust, absorb the income tax drag?
Yeah, and it might be worth, when a trustee of a non-grantor, meaning the trust is paying its own taxes, irrevocable trust makes a distribution to a beneficiary, they could pass out the income. So that beneficiary gets K1 and they're picking up the income on their 1040, and the beneficiary might be, and often is, in a lower tax bracket than the trust. So there's a bracket play there that the trustee just has to be mindful of. We're kind of dragging them to like the minutia of fiduciary income taxation at the end of this, but yeah, that I think that's right.
And it goes back to the notion of like, who is the right trustee, right? Maybe a family member trustee may not know that.
Right.
Any other questions? Rusty?
Can a GST be perpetual and avoid all taxes forever?
Can a GST avoid all taxes forever?
If it's perpetual.
If it's perpetual?
So the rule against perpetuities in Connecticut is 800 years. And my friends who are environmentalists tell me we only have like 4 or 5 generations as a species, so that's probably going to work for forever for most people. You know, right now, there's a lot of jurisdictions that's repealed what's called the rule against perpetuities. It says property and trust has to come out within a certain amount of time. And this says you could just roll that property down, trust after trust, generation after generation. I will tell you that the Democrats don't love this ability to create dynasty trusts. So depending on the election, depending on tax negotiations next year, there may be an effort to limit dynasty trust. I think one proposal I heard was it's only generation skipping with respect to your descendants who were alive when the trust became irrevocable. There's another proposal that those trusts are going to be taxed every 50 years. None of this is the law now, okay? So for right now, you could have very long-term, multi-generational trusts.
There is a federal rule against perpetuities, which I didn't really realize, which is the lives in being plus 21 years. That's the federal rule against perpetuities. I didn't know there was such a thing. It's the federal rule against perpetuities is lives in being plus 21 years. I think New York's is also lives in being plus 21 years. That's how long a trust can be perpetual. It's not perpetual. That's how long a trust can last. So you have to, the trust has to be, will terminate and be paid over to the beneficiaries designated in that trust after lives in being who, when you created the trust, which would be your children and your children when they die, plus 21 years. That's the length the trust can last. That's why it's important in other states. I think Delaware is perpetual, right? Yep. 800 years is Connecticut, but every state has a different one.
Basically, the tax authorities want to get their
some point,
taxes
they
at
want
some
the
point
ta-
sooner
yeah,
rather
at some
than
point.
later.
Yeah, it's also, you know, concern about wealth inequality and concentrated wealth and all of those policy issues.
Maybe one more question. Here we go.
I'm admitted in New York and in Connecticut, and I was a New York practicing attorney for many years. The exemption is different in New York than Connecticut. Connecticut is 13.6, which is the same as the federal exemption, but the New York exemption is 6,980,000, I think. So it's less.
The
Plus, New
state
York-
laws are different,
the
but
state law
federal
is
laws
different. And it has a cliff. That means that if you're 105% over that amount, that exemption amount, it's like there is no exemption, so you're taxed on the first dollar. So New York has a very bad estate
Which is
tax.
7,287,000. If you hit that, you get no exemption. That's why we call it a cliff.
Seek some professional advice. One last question. A former New York resident wants to know if, since she now lives in Connecticut, does her New York will still apply, or does it need to be updated?
I would recommend updating, but it does, I would have to look at it, but it typically would work in whatever state, because there's a way to draft for the exemption no matter what it is. Even our documents assume that the exemption is whatever it is when you die. So it would still work, but I would definitely recommend having someone look at it. I would revise. So.
Terrific. Well, it's been about an hour. I want to throw in a brief commercial for the Arbor Society. Could I see a show of hands of the members of the Arbor Society? Thank you for being a member of the Arbor Society, and we still have some work to do. If you're not a member and want to make a difference in the future of the church, unlike your university or prep school, who really doesn't need more money probably for their endowment, Christ Church does. I ask you to consider leaving a gift to the church. Finally, there's some materials on your table. Our experts have kindly contributed some materials in your little pack that has a little cartoon that I put on there. And so if you want to refer to that, and I want to thank the panelists for doing a fantastic job making a very difficult, complicated subject more understandable. So thank you.